We're news for business people.
Good morning, you're watching All You Need to Know on Bloomberg Quint. I'm Darshan Mehta. Joining me on the show is Agam Vakil. Agam will speak about the FNO trend. I'll speak about the general trend. So at this point of time, if you're looking at it, most of the Asian markets are doing extremely well. The Japanese markets are up almost 1.2%. And the SGX Nifty has managed to rebound from the lows of the day. It was trading absolutely flat, but now has managed close up by 14 points, inching close to the 10,100 mark in trade. So that's the general setup as far as the SGX Nifty is concerned. HDFC Bank was the only ADR that ended with a positive bias. It ended up 0.5% higher. What didn't do well were counters like Tata Motors, ICICI Bank, Dr. Reddy's. All of them fell in between 1.1 to 1.6%. So that's the general trend that you got. Now, if you're looking at crude, that was the big drop that happened. It fell in close to 3% as US inventory gain. So that was the big trend that happened. WTI managed to recover above the $56 barrel per mark in morning trade, but it was trading weak yesterday, and crude overall fell for the most in the past 2 months. So that's the trend, that this 3% drop. Now, base metals on the LME were weak. Aluminium was down 1.6%, zinc was down almost 1%. The other base metals that were weak were tin, which was down 0.2%, and nickel, that was down almost 0.6%. Certain base metals did manage to move up. Lead was up almost 0.3%. Copper was absolutely flat. Now, coming to China, the commodities have opened weak. Most of them are not doing well. Aluminium is down 1.5%, steel is down 1%, copper is down almost 0.3%. So overall trends on Chinese markets are slightly again on the weaker side. We've been seeing weakness happening there. Gold is also losing its sheen. Gold has dropped for the 4th straight session. So that is something that is the weakness that we're seeing. Now, what are the fund flows like? FIs have sold in almost 1,200 crores in the cash market yesterday. This is the NSE provisional number that came out. DIs were net buyers. They bought in almost 995 crores, so slightly less, but no, nevertheless they were buyers. So on a month to date, FIs were net sellers to the tune of 1,400 crores, and DIs were net buyers to the tune of in excess of 3,000 crores. So overall, you're seeing that there is traction. Wherever FIs are not buying, DIs are coming in, but the market over the past few days has been rather weak. And that is the trend that you're seeing on the Nifty. The Nifty dropped for the 2nd straight session. It falls below the 10,050 mark, but the overall trend has been very, very weak for the Nifty. Nifty Bank, Nifty PSU Bank, Nifty Media were dropped the most as far as the index is concerned, and Nifty Auto, Nifty Pharma, and Nifty Realty. In all the sessions, 4 sessions that we've seen this month, all 4 have been negative for them. Now, the Nifty was dropped almost 75 points. What contributed? Reliance was the only one that managed to actually save the Nifty from going down even further. But banks, HDFC, ICICI Bank, HDFC Bank, and SBI, all of them were rather weak in trade. But Agam is here with the FNO sense. Agam, what are you sensing?
Well, Darshan, as you can see, a lot of weakness has come on account of banks, and that's exactly what we are seeing. But let me start off with the Nifty. We have seen about near 5% addition towards open interest, with the Nifty itself dropping by as much as 0.7%, which means there were fresh shots building up in the system when it comes to the Nifty futures. When it comes to the Nifty banks as well, as you saw, there was a lot of weakness on account of the larger ones, so which is why we've seen a drop of 1% with 16% addition in open interest towards fresh shorts. In terms of the India Volatility Index, as one might expect, it did move up, still holding on to the mark of 15, and naturally, predictably, we also saw a little bit of a fall when it comes to Nifty put call ratio that went down to 1.1 from 1.16. But moving in terms of the changes in open interest, we are once again looking at a substantial movement in around the mark of 10,100. So we'll be watching out for that level. Of course, Gen Irrigation moved into the F&O band, so we'll be watching out for that. But a lot of stocks which are buzzing, and Ambuja Cements is one of them, where we've seen a near 9% addition towards open interest towards longs. Other than Ambuja Cements, we're also keeping an eye on Page Industries, which also saw a lot of longs building in. And among the others, there are some weaker counters as well, which brought the index down. So we'll be watching out for those as we move into today's day of trade.
Stock of the day today is IRB Infra. Not a good news coming in for the company. Now, CBI has filed a charge sheet with Pune Session High Court against the company and the promoters. The case has been filed against the subsidiary, which is Aryan Investment Private Limited. A charge sheet has been filed against the promoters, that is Virendra Meskar and Deepak Gagar. A case relates to illegal purchase of government land in Pimpoli, Pune, and it is the preliminary view suggests that the company, it alleges that the company is conspiring to cheat for a land parcel acquisition belonging to the government. However, the press release also reads that the directors have been cooperating with CBI during the course of its investigation and also have denied all the allegations. The management also said that it will take the remedial measures under the law, and they say that they have fully complied with the law, and says this development shouldn't have a material impact on the business of the company. To give a little detail about what the case relates to, now the subsidiary began acquiring the land parcel back in 2007 onwards. It acquired a total 1,200 acres of land, and in early 2009, the company observed that 5% of the total land parcel that it had acquired was illegal. So the company on its own accord proceeded to return the land, but the amount of 5% land parcel for which the charge sheet has been filed is to the tune of 6 odd crore. Now what MK has to say, it says that the charge sheet is filed, it would mean that the case is now over and the investigation is done with. It also says that IRB along with its promoter will file a discharge sheet against this charge sheet as the remedial measure that the company would take. It however expects the stock to remain under pressure for some time. Almost mirroring the same view, HSBC also has written a note which says that it has downgraded the counter to hold from buy. It says that the shares are expected to remain under pressure until unless some clarity emerges with regards to this case, and historically the stock has reacted very negatively on such kind of news flow, and almost has corrected 30% 30% correction was seen in the span of 2 to 3 days back in May 2012 when this report first broke.
And amongst the stocks that we're tracking today morning includes Hudson Agro, where the board has approved raising 900 crores via rights issue. The rights issue committee, of course, will decide on the issue price size and the entitlement ratio, but keep an eye out for this name. You also have IDBI Bank, where the board has approved selling 7% stake in NSDL. This quickly follows the 1.5% stake sale approval that came in for NSE in the last couple of days itself. That apart, we are also keeping an eye out for Claris Life Sciences, where the board said that they have found delisting as the best option for shareholders, even as they consider distributing cash to shareholders. They've finally gone ahead and fixed or appointed IDFC Bank as the merchant banker for delisting, so keep an eye out on that name. That apart, we also saw some earnings which came after market hours yesterday. So on the back of that, we are tracking Pokarna, where the company's revenue fell about 9% and net profit fell 37% to just 12 crores. EBITDA also was down 27%, and the EBITDA margin took a big knock from 39% to just 31%. So a weak set of numbers coming in for that counter. And you also had Arcia, where revenues grew 11%. Net loss was maintained at about 22.5 crores, but it was a good performance as far as the operational level EBITDA was concerned, up 14%. EBITDA margins also saw a slight 150 basis points sort of a knock up. So do keep an eye out for all those names.
Well, the commodity space has been abuzz since the last few days, starting off with oil prices, which saw a sharp decline overnight to the tune of about 2.9%, which is the biggest drop that oil saw for since October 6. Now, this was backed by some inventory data, which was not positive. So, the US gasoline inventory expanded actually 6.8 million barrels for last week, which is the most since the month of January this year. That's the reason we saw a sharp downfall in oil prices. Moving on to the base metal space, we got some mixed cues from the London Metal Exchange, where the index itself actually closed lower for the third consecutive session. Aluminium, which was the top loser, declined as much as 1.6% and touched a 4-month low, while metals like zinc, nickel and tin declined 0.5% to 1% each. Copper and lead actually closed up marginally positive, while copper inventory and spread data actually points out to a bearish tone in the future. If you look at the Shanghai Futures Exchange, all the base metals are trading with a negative bias by about 1% each. Moving on to the precious metal space, gold and silver prices have seen some bit of softness come about. Gold actually closed lower for the third consecutive session, and silver actually closed lower for 7 straight sessions. Now, the gold to silver ratio has reached a year high, backed by China demand. So today, for an ounce of gold, you can buy 79 ounces of silver. But let's shift focus to the currency space. Saloni, what are the cues that you're picking up?
So to start off with rupee, Jayesh, it weakened further yesterday by 14 paise to end lower at 64.52 levels against the dollar after Reserve Bank decided to keep rates unchanged and raise the inflation target for the year. Now, heavy capital outflows along with strong dollar overseas largely pressurized the rupee. On the global front, Asian currencies were trading lower, with South Korean won and Malaysian ringgit losing the most, while dollar index hit a 2-week high after rising as much as 0.3% yesterday on optimism over US tax reform plans. However, it now trades steady at 93.60 levels in the Asian early trade ahead of the release of non-farm payroll data, which is scheduled to release tomorrow. Now, on the flip side, the pound continued to remain under pressure against the greenback on the back of Brexit negotiations. Now, coming back home, dollar rupee is trading flat in the non-deliverable forward market, which indicates a flat opening for Indian rupee in today's trade. Moving on to bond market, 10-year benchmark yields ended 3 basis points lower at 7.03%. And lastly, global funds increased their rupee debt holdings for the second consecutive session yesterday. They infused close to 960 crores according to NSDL data.
A safe and neutral policy from the Monetary Policy Committee, which completed its 5th meeting of the current financial year. In short, there was no change in rates, there was no change in stance, which was maintained at neutral. There was a slight uptick in the inflation forecast, which is now at 4.3 to 4.7% in the second half of the year, and no change also in the GVA growth forecast for the current year. But there is, of course, a lot going on behind the scenes, so not to say that everything is as crystal clear as that short summary makes it out to be in anything but in fact. So if you look at the RBI's projections on inflation, they seem to be fearing that a whole host of factors could come together to push inflation up above the 4% mark and perhaps closer to a band nearing the 5% mark. The factors that they talk about, firstly, they say that the food and fuel inflation have already picked up, and those are the factors that impact household budgets the most. They talk about inflation expectations having firmed up, and in the surveys released in the second half of the day, inflation expectations actually have inched up across all categories. So 1 year, 3 months forward, inflation expectations do seem to be firming up. The biggest risk in perhaps the RBI's view, but certainly in economists' views, continue to be the fiscal side of things. There is concern that farm loan waivers would put pressure on state finances. Central finances would be under pressure as well because of what we have seen happening on GST revenues, and the cuts in certain items and GST rates on certain items could only worsen the fiscal concerns. So the RBI takes note of that. In the October policy, they had said a 50 basis points slippage on the fiscal could add to 25 basis points on the headline inflation based on the baseline projection. So, that is the core of the reason why they have not actually changed rates. The fact that they think there are a lot of upside risk to inflation that could materialize over the next 6 to 12 months. The problem is that while there is a certain amount of decisiveness on their view on inflation, their view on growth is pretty much as tentative as anybody else's. So they talk about some positives playing out for growth. They talk about the fact that credit growth has picked up, companies are being able to raise capital from the markets, and also that, you know, if stressed balance sheets start to recover, you could see investment pick up. But all of those are big ifs. As things stand right now, growth is still weak, even though it is recovering. The RBI has held on to its 6.7% forecast, but there is a chance that even that 6.7% GVA growth forecast would not be met. So the question then is that if growth underperforms in Q3 and Q4, would the RBI once again be tempted to cut rates, or rather the MPC, would it be tempted to cut rates? Well, they've left room. The stance is still neutral, and of course, you know, they have said that they can move in either direction based on that neutral stance. So let's see. For now, though, most people think that this is the end of the rate cutting cycle. You could be in a flat repo rate cycle for some time to come now. Just a quick word on liquidity. There was a lot of anticipation on what the RBI would say on liquidity. They said that yes, liquidity has tightened compared to what it was last year when demonetization deposits had flooded the system, but you are still in surplus mode. You would expect to be in surplus mode over the course of this fiscal. You would turn neutral early part of next fiscal. And then finally, Viranacharya said that if required, they would use open market operations either to absorb liquidity or to inject liquidity as the situation demands.
Well, analysts and brokerages unanimously expect that there will be no rate change from the RBI for the rest of FY18. But when it comes to you know, FY19, some of them are clear that RBI will be on an extended pause for all of 2018, while some others are waiting for more data to come in to understand the further direction as far as the policy action is concerned. Let's take a look at what some of the brokerages have to say. Motilal Oswal says that they expect inflation to rise towards 5% by March 2018, and it's primarily on account of a low base. On the other hand, while they expect real GVA to grow at a slower rate than expected by the RBI, they expect no rate action, at least for the remaining part of FY18. CLSA has brought out an important point and said that credit growth remains massively below what would support a cyclical upswing. So the discussion of a rate cut has more merit given the weakness in growth, but they do expect CPI inflation to rise a little further, which means that there will be no change in the monetary policy in 2018 either. Macquarie says that they read the policy statement as neutral. They expect the RBI to be again on an extended pause because they believe inflation risks are contained and growth is in a gradual recovery mode. But a more important point that they brought out is with respect to the ongoing liquidity tightness, which is expected to persist by or into the fiscal year end as well. So they expect market rates to remain under pressure, and that would potentially hurt financial stocks, especially NBFCs, which had so far been a beneficiary of the benign liquidity conditions. So that's an important point that they have brought out. As far as the FY19 expectations are concerned, they say that a rate hike will be premature on expectations of a gradual growth recovery and inflation risks remaining contained. You have Nomura, again they believe that growth and inflation both will head higher. On the forex strategy, they say that they remain constructive on the Indian rupee, while when it comes to the rates, they're not expecting any further open market operations, so they expect bond markets to consolidate around the current levels. And lastly, we also have Kotak, where they've said that the tone of the communique was broadly neutral, and they've maintained the call that the MPC will remain on a pause for the rest of FY18, while they believe that the focus will now start shifting to MPC's possible moves in FY19, but they say that the rate cycle or the rate cut cycle is broadly over, at least for now.
Infosys has filed a consent application with market regulator SEBI. The company said in a filing to the stock exchanges. The company said that it failed to take prior approval from the NRC, which is a nomination and remuneration committee, and the audit committee for the severance agreement that it reached with the former CFO Rajiv Bansal. Remember, Rajiv Bansal quit Infosys in October 2015, and as per the severance agreement, he was supposed to be paid nearly 17.38 crore rupees, which is nearly 24 months pay. The entire pay or severance package came under the cloud after promoters, shareholders like Murthy raised the red flag over this payment. Infosys also has said that it failed to disclose certain information with respect to the severance agreement, cessation of the severance agreement, and the arbitration that it initiated with Rajiv Bansal post that. Rajiv Bansal started the arbitration with Infosys in April 2017, while the payments made to Bansal stopped in 2016. Infosys had so far paid 5 crores to Rajiv Bansal, and Bansal is seeking the remaining amount as part of the arbitration proceedings. The entire consent application will take a couple of weeks and months before SEBI accepts the application, and then the high-level committee of SEBI would sit and decide what could be the penalty or what could be the fee, price that Infosys would have to pay for this failure to disclose this information.
On brokerages, first we have is Ventura Securities on Solar Industries. Now, the brokerage has initiated a buy rating on the stock with a target price of 1537, which suggests a potential upside of 37% over the next 27 months. Now, Solar Industries is a dominant player in explosive industry, and its revenues is nearly 5 times to its next compared to its next peer. That is a manufacturer and exporter of industrial explosives and defense equipments. The infrastructure growth and mining boom is expected to boost the demand for explosives going forward, while opening up of India defense sector and expansion in international markets are added positive when it comes to Solar Industries. On the back of this, the brokerage is expecting the company's revenue, EBITDA and net profit to grow at a compounded annual growth rate of 25%, 27% and 29% over FY17 to FY20. The brokerage is also expecting healthy operating cash flows going ahead, and they're expecting the net debt to equity to remain at 0.4 times going forward. They are also expecting the return on equity and return on capital employed to expand to 22% and 29% by financial year 2020. Second, we have is Credit Suisse on PI Industries. Now, the brokerage has initiated coverage on the stock with an outperform rating and a target price of 1150, which suggests a potential upside of 20%. PI has two businesses, that is custom synthesis and manufacturing, that is CSM, and domestic agrochemical business. Now, in the CSM business, it is strongly positioned as its order book of more than $1 billion provides good visibility going forward. And in the CSM business globally, it has currently around 5% of market share, which offers the company ample opportunity to grow. Also, when it comes to the domestic business, the focus on specialty product will be a key differentiator according to the brokerage. Now, the brokerage is expecting the revenue of CSM business and domestic business to grow at a compounded annual growth rate of 20% and 14% over FY18 to FY20. They are saying that the EPS would grow at a CAGR of 18% over the same period, with better growth for CSM in the second half of financial year 2018 itself.
Well, on to some more stocks to watch based on the cash market volumes that they generated yesterday. Starting off with Reliance Industries, it was up more than 1% yesterday and saw delivery buying of nearly 600 crores. The delivery volume nearly doubled at about 65 lakh shares versus the 5-day average, and the total volume too surged nearly 50% at 1.2 crore shares versus the 5-day average. Vakrangi, the second stock to watch out for, it was down 2.5% yesterday and saw delivery selling of nearly 90 crores. The delivery volume was down 46% at 12 lakh shares versus the 5-day average, and the total volume too was down nearly 80% at 20 lakh shares versus the 5-day average. The last and final stock, Vedanta, it was down 2.3% yesterday and saw delivery selling of more than around 200 crores. The delivery volume was actually up more than 100% at 70 lakh shares versus the 10-day average, and the total volume too surged about 90% at 1.5 crore shares as compared to its 10-day average.
US, unlike a market for some of the other companies, for Cipla it's still a nascent market. But I think what we've seen of it is very encouraging. You know, also because of our size relative to others, it's an opportunity for us. It takes a lot longer to get to your desired outcomes in the US, share and things like that. And there are a lot of geopolitical concerns as well now with, you know, with the tax code and everything else that's happening. But it's still a very attractive market. It is the largest market in the world. And I think Cipla believes it has a reasonably good pipeline now to address the US. So it will begin to unlock. We've had some launches in this quarter. The real effect of them will come out in Q4. because it does take time to build share, etc. But I think we're on a good track there.
But you had a couple of launches over the past few quarters, but it seems that the US sales have plateaued. Is that the street seems that could be a concern for you? Are you sensing it to be a concern?
Actually, our biggest launches came only this quarter. Okay. Before that, we were having very small launches. We had our share of launches, but those launches were just about enough to offset a little bit of the price erosion that we saw in the market. Our real trajectory starts now, right? And I think Q4 onwards, I think we should be seeing at least a bump up in our US sales.
Okay, so let's get a macro view and then I'll come to the micro. So let's say 3 years from now, how do you see the US markets for Cipla?
Well, I think 3 years from now, you'll have possibly one of our inhalers in the market already, a couple of more likely to get in, right, around that time period. 3 years from now means about 21, right, 2021. So we would see that. We would see the maturing of a pipeline around the injectable oncology institution space. We would see a couple of limited competition opportunities from the emergent pipeline that are coming out. So I think US would be, according to me, much more sizable than what it is today for Cipla. Right, we expect the US share to increase quite dramatically from where it is today.
No, but do you have a number in mind in terms of how much sales?
We have a number.
Ultimately, it boils down to numbers.
Yeah.
I can give a big prediction, but if I don't give numbers to back it, it's just a prediction. So give us some numbers. Where do you see the US markets?
No, so we know the number, right? Okay. I mean, we've got our own planning, and we know the number, and we know what range that number will be. Okay. I would probably say that we believe that the US should at least be 25 to 30% of the company, right, in 3 to 4 years.
25%?
Yeah, 25 to 30% is what our aspiration for the company is in the next 3 to 5 years.
Well, despite a challenging environment in the US, it remains the biggest opportunity for Cipla, and that's the word coming in from Umang Vohra, MD and CEO of Cipla, speaking to Bloomberg Quint's Darshan Mehta. And Vohra said that he expects the US markets to contribute to as much as 25 to 30% of the sales in 3 to 5 years. But there's a lot to talk about over the course of the day, and you will find all the live market action on Bloomberg Quint. There are also a few stories that you should consider reading on the website bloombergquint.com. Here they are. Infosys plans to turn disruption to its advantages by focusing on newer digital technologies, which will, which will begin showing results in the coming financial year, according to billionaire co-founder, chairman Nandan Nilekani. And International Solar Alliance, championed by India and France, came into effect Wednesday, aiming to promote affordable sun-powered electricity to its members through global tenders and cheap financing. But with that, it's a wrap on this edition of All You Need to Know. Indian Open is up next.